In Chapter 8, we went through the preparation of a master budget, and we talked about the advantages and disadvantages of budgeting and best practices. Chapter 9, we're going to continue our budgeting discussion by looking at something called a flexible budget. You may remember from our discussion in Chapter 8 that budgeting is effectively a planning tool, but if used properly, it is also a control tool in that by analyzing departures from budget, we better control what we're doing and the decisions we're making for our company. So we're going for this example to use a clothing manufacturer. And we basically have prepared a budget for one of our product lines for the upcoming year. And here is the budgeted data. Variable costs. We have budgeted direct materials, and this is in yards. We're saying 4 yards of direct materials per clothing item per unit. We anticipate the cost to be $5 per yard, so we anticipate spending $20 in direct materials per unit. For direct labor, which we will define in hours, we're going to budget 1.5 hours of direct labor per unit, a cost of $10 per hour, which gives us a direct labor cost per unit of $15. Then variable manufacturing overhead, we have determined we're going to allocate that based on direct labor hours. So again, we'll look at the number of direct labor hours per unit, which is 1.5. We're anticipating variable manufacturing overhead to be $6 per direct labor hour, which means $9 per unit. And then our variable selling and admin costs, we're budgeting at $3 per unit. Then for fixed costs, we have fixed manufacturing overhead that we're budgeting at $450,000, and fixed selling and admin we're budgeting at $400,000. We're budgeting sales to be 25,000 units at a sales price of $100 per unit. Okay, so those are the assumptions that we would use to build our budget. Now, what actually happened? Well, variable costs. Direct materials, we used $77,000, I apologize, 77,000 yards of material, and we paid $5.10 per yard. Direct labor, we actually used 28,000 hours at an hourly rate of $9.60. Again, because we're allocating variable manufacturing overhead based on direct labor, our quantity would also be 28,000 hours. Our variable cost per hour, $7. And then our variable selling and admin came in at $3 per unit. Our fixed costs came in, fixed manufacturing overhead, actual came in at $390,000. Fixed selling and admin came in at $400,000. Our actual sales ended up being 20,000 units at a sales price of $95 per unit. Okay, so that's what actually happened. Now, let's take this data and let's go to the next worksheet where we are doing a comparison of the budget to actual. Now, notice what we're calling this budget. This is our static planning budget. This budget was prepared using all of the budgeted assumptions. Then our actual results prepared using the actual results. So again, we'll walk through the calculation of each of these. The budget, we budgeted, you'll remember, 25,000 units. So our sales is calculated at 25,000 units times the $100 budgeted sales price. Direct materials will budget at the 25,000 units budgeted times the $20 direct material cost per unit. Direct labor, 25,000 units times the $15 budgeted direct labor cost per unit. Manufacturing overhead variable will be the 25,000 units that we budgeted to be sold times the $9 budgeted variable manufacturing overhead. And then selling and admin, the 25,000 units budgeted times the $3 unit per unit variable selling and admin. If we add those up, we get total budgeted variable costs of $1,175,000. Subtract that from our sales, and that gives us a contribution margin of $1,325,000. Then from that, of course, we'll subtract our fixed overhead and our fixed selling and admin, which comes straight off the assumption sheets. Those total $850. We subtract that from the contribution margin, and we end with net operating income budgeted at $475,000. Okay, now let's look at what really happened. We actually sold only 20,000 units, and you will remember from the assumptions, we sold those at $95 per unit, giving us sales of $1,009,000. Direct materials came in at 77,000 yards at $5.10 per yard. Direct labor came in at 28,000 hours times a cost of $9.60 per hour. Manufacturing overhead, the same 28,000 direct labor hours at $7 per hour. And then the selling at an admin was the 20,000 units we sold at the $3 per unit. That, if we totaled those variable costs up, gives us $917,500. We subtract that from our sales, and that leaves us with a contribution margin of $982,500. We pull in our fixed costs. Manufacturing overhead came in at $390. Selling and admin came in at $400 for a total of $790,000. Subtract that from our contribution margin, and we had actual net operating income of only $192,500. Okay. Now, in the variance column, you'll notice we've taken the difference between the planning budget and the actual results. And this column, U or F, that stands for unfavorable or favorable. So right off the bat, we have an issue because we have an unfavorable variance in number of units sold of 5,000 units. Our sales are under budget, so it's unfavorable for 600,000. Now, notice all of our variable costs are actual under budget. That's favorable. But we need to be careful. Favorable doesn't always mean good, because we know we sold fewer units than we had budgeted. So to some degree, we would expect our variable costs, which are tied to units, to be less than what was budgeted. So this favorable variable cost may be a function of selling fewer units, which is not favorable. So we have a total variance in variable costs of $257,500. We subtract that from the variance in sales, and that leaves us with an unfavorable contribution margin. So what that tells us is that the unfavorable variance in sales was more than the favorable variance in variable costs. Fixed costs, 60,000 actual, less than budget. Selling and admin came in right on the money. And so we have further favorable variance in costs, which leaves us with a variance in net operating income of $282,500, which is unfavorable. Now, this is all great. We have some good information here. We know where we were off. What we don't know is why, because we know that we sold fewer units. So right off the bat, as I mentioned, some of these variances may be due to the fact that we sold fewer units. But there were other issues as well. If you remember, our sales price ended up being less than what we budgeted. Our direct material cost actually ended up being more than what we had budgeted. Our direct labor cost ended up being less. So the bottom line is these variances may arise from a number of different parameters, whether it's the number of units, whether it's the amount of material, whether it's the cost of the material, we don't know. And without knowing how much of the variance is related to what, we really can't do anything to address it. So this is where the flexible budget concept comes in. So I'm going to move over to this next worksheet that's entitled Activity Variance. And you'll see in column C, the static planning budget. These are exactly the same numbers from this worksheet. But what you see next to it is a column called Flexible Budget. And you'll notice in the flexible budget, there are only 20,000 units sold. Now, here's what we're doing with the flexible budget. We're saying, okay, let's eliminate or let's identify what the variance is that is specifically related to the fact that we sold fewer units than we had budgeted. And so what we're basically doing is redoing our budget with an activity level of 20,000. So the sales figure is calculated by taking the 20,000 times our budgeted sales price per unit. The direct materials is calculated by taking the 20,000 units we sold times the budgeted cost per unit of $20. Same thing with direct labor, the 20,000 units times the $15 budgeted. Same with manufacturing overhead, same with selling and admin. So what that means is we add those up, and if we had met our budgeted cost on a per unit basis, but had budgeted to sell only 20,000 units, we would have actually had budgeted variable costs of $940,000. We subtract that from the $2 million in sales, and that would have left us with a contribution margin of $1,060,000. Now note the fixed costs are the same for the planning budget and for the flexible budget. That's because by definition, fixed costs would not change by virtue of the activity level being different. So we'd still have fixed costs of $850. We subtract those from the contribution margin, and we have budgeted net operating income, flexible budget of $210,000. Now, when we look at these variances are strictly related, only related to the fact that we sold fewer units than we had budgeted. They're referred to as the activity variance. This is the variance that arose strictly because our activity level was different. So sales were unfavorable to the tune of $500,000 strictly because we sold 5,000 fewer units. And as we would expect, if the sales are unfavorable, our variable costs are all going to be favorable. We sell fewer units at the same level, cost level per unit, we're going to have less in costs. So we have total variable cost variance of $235,000. We subtract that from our variable, or we take the variance for the contribution margin, and that's still unfavorable. So the sales variance unfavorable is higher than the cost unfavorable variance. And then again, no variance for the fixed costs, and we come down to a variance in net operating income of $265,000, which is the amount of the variance strictly due to the fact that we sold fewer units. It is the activity variance. Okay, so now we have an understanding of the impact on the variance due to a decrease in activity. What we still need to understand is the impact that arises from our differences in sales price, differences in cost. So here is where I've moved on to the next worksheet. We're going to do a comparison between the flexible budget and the actual results. So the flexible budget, remember, was prepared using the actual activity at the budgeted amount. We compare that to actual results, and the only difference between these two columns will be either the sales price or the cost per unit. So again, I'm not going to walk through these two columns. Again, the flexible budget numbers came straight from the previous worksheet. The actual results column came from the planning versus actual. So those numbers are the same. We're just doing different comparisons. So if we look at sales, we see that there is an unfavorable $100,000 difference, variance between the flexible budget and the actual results. This is the revenue variance, and it is the amount of the variance that is attributable to the fact that we sold the units for $5 per unit less than what we had budgeted. We sold them for $95, not $100. Direct materials, we have a favorable variance of $7,300. This is because the cost of the direct materials per unit ended up being less than what we had budgeted. Now, I want to point something out here. We paid $5 per yard for the direct, or we budgeted $5 per yard for the direct materials. We paid $5.10. Seems like we should have an unfavorable variance. What isn't taken into consideration there, though, is how much material that we used. So that also could impact the difference in cost of direct materials. Same thing with direct labor. We've got favorable $31,200. Now, notice manufacturing overhead, we actually have an unfavorable spending variance, which means that the cost, the impact of higher costs exceeded the benefit of selling fewer units. We come down here and for total variable costs, we have a favorable variance of $22,500, but an unfavorable variance in contribution margin, which just tells us that the savings in costs was not enough to offset the reduction in the sales price. Then fixed manufacturing overhead is a favorable variance. We brought it in at $390,000 versus $450,000. Selling and admin, no variance, came in at budget. And we come down to an unfavorable variance for net operating income, of $17,500. So again, this is the amount of the variance between our planning budget and actual results that is strictly attributable to the sales price and the cost per unit. It ignores or has eliminated the impact of the fact that we sold fewer units. This is critical because when we look at our costs came in different versus our sales came in different, we may go to different departments, different individuals to find reasons for that. And we can't do that if we can't segregate those out. Now, On this last worksheet, all I have done, this is what's called a flexible budget performance report, and I've effectively just combined the two previous worksheets into one, so that in one report you see, here's your static planning budget, your flexible budget, your actual results. The difference between your static planning budget and your flexible budget are your activity variances, the variances that arose because we sold fewer units, and between the flexible budget and the actual results, we see our revenue and spending variances. Those variances that arose strictly because the price was different or the costs were different on a per unit basis. So there's no new information in this report from those two previous worksheets. It's just that all of the information is in one place. Now, just another comment about the spending variances over here, the 7,300, 31,2. Next week in chapter 10, we're going to look more closely at these spending variances and identify for those direct materials, okay, if we spent $5.10 versus 5 cents per yard, how much of this difference is because we may have used more or less material than we had budgeted on each unit. So we're going to break these out even further, but we'll save that for next week.